Hello everyone, myself Karupusamy, Assistant Professor, Department of Banking and Finance from Erode Arts and Science College at MMS. Today I am share with basic knowledge of financial management. So all of you welcome. What is financial management? Financial management is the first part of introduction to financial management for any business. It is important that the finance procedure is invested in a manner that the returns from the investment are higher than the cost of finance. It's to reduce the cost of finance and sufficient availability of funds. It deals with the planning, organizing and controlling of financial activities like the procurement and utilization of funds. Then, the nature of financial management. Financial management is applicable to every type of organization, size, kind of nature. Every organization aims to utilize its resource in a best possible and profitable way. It is a centralized function helpful in decision of top management. It applicable to all type of concerns. It means financial planning or controlling and flow up. Its function is different from accounting function. It is an essential organ of business management. It related with the different disciplines like economics, accounting law, information technology, mathematics, etc. Objectives of financial management. It's classified 4 types of objectives. The first one basic objectives, and second one operational objectives, third one social objectives, the last one research objectives. The first one basic objectives is profit maximization and wealth maximization. The second one operational objectives is timely availability of requirement of finance. Then most effective utilization of finance. Then safety of investment, growth of the enterprises. Then third one, social objectives, is timely payment of interest, then payment of reasonable dividend, then timely payment of wages, fixing settlement with the suppliers, then timely payment of taxes, maintaining relationship with the financier. Then research objectives, the last one, research objectives, is research into new and better source of finance. The basic objectives, the first one, profit maximization. Profit maximization is that all financial decisions are made with a view to maximize profit of the firm with all its investment and savings. The objectives helps in measurement of economic performance and efficiency of any business concern. Like advantages, the profit maximization like advantages, economic survival, a measurement standard, social welfare and economical welfare. Disadvantages, assigning of the concept of profit, ignores time value of money, ignores risk and ignores quality. Wealth maximization. Wealth maximization is maximization of shareholders is wealth. Financial management must select those decisions which create most wealth for the owners. If 2 or more financial profit maximization, objective of financial management means that all financial decisions are made with a view to maximize profit of the firm with all its investment and savings. These objectives help in measurement of economic performance and efficiency of any business concerns. Then second one, operational objectives, is 4 kinds. The first one, timely availability of requisite finance. It is a very important operational objective of financial management. Is is to ensure that requested funds are made available to all the departments, sections or unit of the enterprises at the need time, so that the operational life of the enterprises goes smoothly. The second one, most effective utilizations of finance. Throughout the enterprises, the finance must be utilized most effectively. This is yet another important operational objective of the financial management. Then third one, safety of investment. The financial management must primarily look to the safety of investment. The channels of investment may bring in less returns, but investment must be safe. Loss of investment in any one line may lead to capital depletion and ultimately tell upon the financial health of enterprises. Then fourth one, growth of the enterprises. The financial management must plan for the long-term stability and growth of the enterprises. The limited finances of the enterprises must be so utilized that not only short-run benefits are available, but enterprises grow slow and steady in long run also. The third one, social objectives, is 6 kinds. First one, timely payment of interest. The financial management must see to it that interest on bonds and debentures or other loans of the company is paid in time. This will not only keep the creditor satisfied with the company or adding to its goodwill, but also prevent any untoward consequence of the non-payment of interest in time. Then second one, payment of reasonable dividends. An important social objectives of financial management is that shareholders, the equity members of the company must get at least some regular dividends. Then third one, timely payment of wages. The financial management must make a provision for the timely payment of wages to workers. This is necessary to keep the labor force satisfied and motivated. Further, if wages are paid on time, the legal consequence of non-payment of wages under the Payment of Wages Act. The fourth one, fair settlement with suppliers. The financial management must make it a point to settle accounts with suppliers and businessmen in time, in a fair way, otherwise the commercial reputation of the enterprises will get a setback. The fifth one, timely payment of tax. An important objective of financial management would be to make timely payment of taxes to the government so as to avoid legal consequence and also fulfill its social obligation towards the state. The sixth one, maintaining relation with the financiers. The financial management must develop and maintain friendly relation with the financiers, banks, financial institutions and various segments of the money market and capital market. When good relations are maintained with financiers, they may come to the rescue of the enterprises in situation of financial crisis. The last one, research objectives. Research objectives is the successful attainment of various objectives by the financial management. Requires it to follow a research approach. It must research into new and better sources of finance and also into new and better channels for the investment of finance. The research objectives is innovation, planning and strategies, and finally success. Functions of financial management. First one, estimation of capital requirements. A financial manager has to make estimation with regards to capital requirements of the company. This will depend upon expected cash and profits and the future programs and policies of your concern. The second one, determination of capital composition. This, once the estimation have been made, the capital structure have to be decided. This involves short term and long term debt equity analysis and additional funds which have to be raised from outside parties. Then third one, sources of funds. The sources of funds, it is additional funds to be pursued. A company has many choice likes. The first one, likes of the shares and debentures, issue of shares and debentures, loans to be taken from banks and financial institutions and public deposits, more than etc. Then investment of funds. The financial manager has to decide to allocate funds into profitable ventures so that there is safety on investment and regular return is possible. Then disposable surplus. This is first one, dividend declaration. It include identifying the rate of dividend and other benefit like bonus. Second one, retained earnings. Retained earnings is the volume has to be decided which will depend upon the exceptional innovation of the company. Then management of cash. Management of cash. Financial manager has to make decision with regards to cash management. Cash is required for the many purpose like a payment of salary, wages, bills, creditors and the PB bill, water bill, the more than etc. The last one, financial control. The financial control is financial manager has not only to plan, pursue and utilize the funds, but he also has to exercise control over the finance, ratio analysis and financial forecasting and cash and profit control, etc. Sources of financial management. First of all, what is source? A businessman or entrepreneur which side collected from funds or required sources, that is source. Source collected from two types, dividend or interest. The sources collected from shareholders or public deposit more than otherwise. It is under the dividend category of repayment. Same, the sources collected from financial institutions and banks, commercial banks, it is under the interest category of repayment. Source of financial management. On the basis of period, three types, short term, medium term, long term. The first one, short term. Short term is trade creditors, bank loan, commercial paper, cash credit and provision for depreciation, provision for taxation. Then second one, medium term. Medium term, it is debenture, lease financing, loan from banks, public deposit. The last one, third, long term. Equity shares, preference shares, debenture, venture capital, financial institution. Then according to ownership, it is owned capital and borrowed capital. The first one, owned capital, it is equity shares and preference shares. Then second one, borrowed capital. Borrowed capital is debenture and financial institution. On the basis of source of generation, internal source and external source. The first one, internal source, is equity share capital and retained earnings. Second one, external source, financial institution, loans from bank, preference shares, debentures, public deposit and lease financing, commercial paper, trade creditors, etc. Thank you for giving golden opportunity. Thanks a lot.